Hi everyone, I would like to share a quick update on the markets and the performance of Syfe investment portfolios with you. Following the most recent Fed meeting in September and its higher for longer interest rate guidance, the global stock market faced headwinds with the MSCI World falling 3.4% in the third quarter of 2023. The 10-year Treasury yield climbed to its highest level since late 2007, reaching almost 4.9%. This has led to bond prices correcting by 3 to 4% in Q3, with the US Treasuries and investment-grade bonds witnessing fluctuations across a range of quality and tenures. The Singapore REIT market also mimicked the performance of global equities, with the iEdge S-REIT index declining by 4.2% in total return in Q3 2023. Now, higher interest rates have led a lot of investors to move their investments into safer instruments such as money market funds and fixed deposit instruments. While the Fed has indicated the possibility of another rate hike this year, the likelihood of Fed actually carrying it through remains low, with the market pricing in an 86% probability of no rate hike in November. We do, however, see the path to rate cuts stretch longer into 2024 and beyond. Now, what does this mean for your portfolios going forward? The core portfolios are meant for long-term growth and capital appreciation. Equity markets may continue to exhibit short-term volatility amidst higher interest rates, and the Israel-Palestine conflict may cause oil spikes, hurting equity valuations. However, history has shown that the impact of such events are limited on the stock market. The core equity 100 portfolio is still up close to 10% on a year-to-date basis, and we encourage investors to DCA into these equity portfolios during this volatile period to capitalize on the subsequent market rebounds. History has actually shown that the equity markets on average generate double-digit returns once the Fed stops its rate hiking cycle. For REIT Plus investors, it has been particularly challenging as the S-REIT market has generated flat total returns over the last 3 years. As you can see from the chart, S-REITs faced the double whammy of COVID-related restrictions and the subsequent interest rate tightening that limited its upside potential since the highs in 2020. However, when you zoom in into the long-term history of S-REITs, it is evident that S-REITs can generate handsome returns and dividends over a longer cycle. As the interest rate normalizes in the new year, we can see a surge in S-REIT prices. At the current juncture, we encourage REIT Plus investors to remain patient and continue clipping the attractive dividends at 5.8% plus from S-REITs while waiting for the markets to recover in the new year. Over the long term, S-REITs should be able to generate you 5 to 6% dividends and an additional 2 to 3% of capital appreciation. For Income Plus, investors are torn between generating higher yields and preserving their capital. While Syfe's Income Plus portfolios are able to generate monthly dividends of up to 6%, the price returns have been negative so far this year due to continued rising interest rates. We have noticed some investors who have shifted their funds towards safer investment options of Cash Plus, where they are able to lock in 3.7% projected or guaranteed return on a relatively low-risk basis. We encourage Income Plus investors not to be discouraged by the market fluctuation in the past few months. We believe that bonds and Income Plus portfolios provide the most compelling risk-reward in the current market environment for long-term income-seeking investors. As we see from this chart, bonds tend to generate an average return of between 8 and 13% after the Fed pauses its rate hiking cycle. New and existing Income Plus investors can consider deploying lump sums into their Income Plus portfolios, as the historic high yields currently in the bond market provide an opportune time to generate high income with potential for equity-like returns in the new year.